First of all, before I begin, let me congratulate those of you who took the Introduction to PFM examination in October and who passed the examination. I say congratulations to you all, and pleased you'll now be proceeding with the PFM for Somaliland program. If you're joining that program late, you'll obviously have some catching up to do. The first of the webinars is available on my YouTube site, Michael Parry Consulting, and I'm also going to put it, hopefully later on this week, I'll put it on the learning management system as well, so you'll be able to see it there together with all of the slides. Right, today we're going to move on to Workbook. Oh, one other thing I should just mention on those who didn't pass the examination, if they're watching, commiserations to those who failed. That is the end of your formal studies on this program, but you will be able to study the PFM for Managers program, which we are just in the process of starting, which is open to anybody and will cover the same material. So there is still an opportunity for you to continue to study PFM. As I said, the subject of this morning's presentation is Workbook 2 on budget execution. Quite a lot of material to cover, so I'll press on. We have 8 topics that we are going to cover this morning and this afternoon. It's morning in the UK, afternoon with you. Number 1 is fund release, budget management, expenditure control, receiving and paying money, the concept of the Treasury single account, bank reconciliations, cash management, and finally fiscal decentralisation. And these all form part of budget execution. This is a simplified version of the diagram that is in the workbooks, showing the 4 stages of budget execution. Stage 1, authorization, which we deal with as fund release. Stage 2, commitment, which we deal with under budget management. Stage 3, payment authorization, which we deal with as expenditure control. And Stage 4, payment, where we deal with cash management. That's the sequence. The goals of budget execution can be summarized under 4 headings. Compliance. The objective is to make sure that when funds are spent by government organisations, they are done so in compliance with the laws and regulations of Somaliland. Secondly, adaptability. Because situations change, the needs change, the system must also be able to adapt to changing circumstances and emergencies that arise. Thirdly, efficiency. The budget execution system should be efficient, and we'll see what that means when we get to efficiency, but it certainly means minimizing cost. And finally, you have to manage cash, liquidity management. Those are the 4 goals of budget execution. And just a conceptual point. We normally talk about accounting systems being information systems. But when the accounting system is used to execute the budget, it becomes what is known as a purposive system, a system that actually does something. If you didn't have the accounting system, you couldn't pay suppliers, you couldn't pay salaries. So the accounting system is more than an information system, it becomes a purposive system. That's a conceptual point, it's not in your course, but I think it is important. Okay, let us now look at the first stage of budget execution, fund release. And let me explain that in terms of options. You could have a situation where once the budget is passed, the amounts in the budget are immediately available to the different ministries to spend. That's it. But Treasury would have no control over the process. They could just spend the money because they've got it in the budget. Virtually no public sector organisation would operate like that. and most operate under the second option, 1.2. Funds are released in tranches, what is known in many countries, including Somaliland, as warrants. And that can be combined with the banking arrangements. Now, this takes us beyond fund release, and we'll come back to talking about banking arrangements. But I think it is good to link these different fund release options with different banking options. So one option could be that you could pay funds into any bank, you could pay the funds into a ministry bank account. And that could work under 1.1 or 1.2. So each ministry has its own bank account. That, in fact, is the traditional system. Or you can manage the funds through a Treasury single account. And you can have any combination of those two fund release options and those two banking arrangements. Let's look at an example. Supposing the Ministry of Health in Somaliland gets an annual, has a budget of $1 million. Under option 1.1, that would be warranted in one tranche. In other words, once the budget was passed, then the Ministry of Health would be able to spend $1 million. Or you could have a series of quarterly warrants. I mean, they could be monthly warrants, but most countries would use quarterly warrants. And we've just put some figures up here dividing that $1 million into 4 quarterly warrants. And the banking arrangements, you could have a bank account for the Ministry of Health, and you could pay the $1 million straight into it under option 1. Or if you take that away, you could have that each tranche is paid into the Ministry of Health bank account. That would be, say, the traditional approach to banking. Or if we take that away, we could have a Treasury single bank account, and either the $1 million or the quarterly warrants could be paid into the Treasury single bank accounts. So there's 2 options for fund release. You either release the whole funds in one go, or you release it in a series of warrants, tranches, and 2 options for banking arrangements. You either have a Treasury single account or you have ministry bank accounts. Now, fund release and warranting doesn't stop at the level of the ministry. You warrant funds quarterly to your different ministries. The ministries will then have to sub-warrant that to the organisations under the ministry. So if it's the Ministry of Health, they may, for example, have a primary healthcare department. I don't know the structure in Somaliland, but it's quite likely you'll have a primary healthcare department. And then under that, you'll have sub-organisations such as a series of health centres at locations throughout the country. So you'll have to make funds available to each of those through a process of sub-warranting. Now, the detail of that, how that works is specific to each country, and it will be in your financial regulations and procedures in Somaliland, and it's not detail that you will be examined on. But the principle is one of warranting and then sub-warranting. Just look at a simple example of that. Ministry of Health gets a budget for $1 million. The first quarter budget warrant is $200,000. $100,000 is sub-warranted to primary health care, and then there's a sub-warrant to the Hargeisa Health Centre, if such exists, of $20,000. So it's a cascading system that the funds are progressively warranted out to the spending units. It's a control system. Control for cash, control to make sure that the objectives of your budget execution system are met. Second heading is budget management. What do we mean by budget management? Well, the definition is the management of budget appropriations to make funds available to spending units in an orderly manner according to the law to meet spending unit operational requirements. I think that's a good definition, and I think it explains very clearly what we mean by budget management. You make funds available to the spending units in an orderly manner according to the law to meet operational requirements. And the requirements of a budget management system. Well, first of all, it's got to record budget appropriations to each spending unit. That means that a ministry like the Ministry of Health has got to be able to allocate its own appropriation over the different spending units. It sounds easy. Sometimes it can be complex. I know that in Nepal, for example, they were never able to get that arithmetically correct. If you added up all of the appropriations to spending units, it never came back to the budget figure. They always got it wrong. And then you've got to also keep a record of the funds that are released by spending units. And finally, you've got to manage the fund release in terms of cash flow and total budget appropriation. Cash flow we will talk about later on. Total budget appropriation, you've got to make sure that you keep within the budget ceiling. And to understand how that works, you've got to look at the budget management, the stages of expenditure. Again, we'll stick with our Ministry of Health, budget of $1 million on the 1st of January, whichever year, of which $200,000 is warranted for quarter one. And the Ministry of Health then places an order for a new vehicle at a cost of $15,000 on the 15th of February. That's a commitment. It's committed the funds. Not spent them as yet, it doesn't receive the vehicle. There's no liability, but it has committed to spending that money. The vehicle's delivered and billed on the 1st of March. That now becomes an actual liability. The Ministry of Health now owes that money to the supplier, who is finally paid on the 30th of March. Those are the stages. And a requirement of public sector financial management is you need to track expenditure all the way through those stages. Whereas in the private sector, you would actually only start tracking expenditure at the liability stage. Because in the private sector, you don't have this concern with keeping within budget in the way you do in the public sector. So in the public sector, you need to track expenditure all the way from budgets through warrants, commitments to liabilities and actual cash flow. How you do that? Well, fundamental to this is the concept of commitments. You just don't really, commitments exist in legal terms in the private sector, of course, but you don't need to track them in the same way. But in the public sector, it's important because a commitment is a preemption of budget funds. And incidentally, if you read any US textbooks, you'll find they use the term obligation to mean exactly the same as commitment. I'll use the term commitment. It's probably more common, but if you do find the term obligation being used, it has the same meaning. And in our example, the new car is ordered by the ministry for $15,000. Once that car is ordered, that $15,000 is not available for any other purpose. You have to put it on one side into a sort of virtual piggy bank in which you keep your money or whatever you have in Somaliland. There are different types of commitments. There's a hierarchy of commitments. At the top end is a legal commitment. The order for a car is probably a legal commitment. You've signed an order. You have to buy it. They're clearly defined and they're easy to monitor. Underneath that, you get commercial commitments. And in some cases, let's stick to our car order. You may order a car, but it may not be a legal commitment. It may simply be that you've said to the supplier, I want this particular car, please get it for me. It's a commercial commitment, but you haven't legally committed yourself to it. You could change your mind. Commercial commitments like that are less clearly defined and more difficult to monitor. And then you have political commitments. The Minister of Health says that we are going to have a country immunization program against measles at a cost of $5 million. That's a political commitment. There is no contract with anybody. And if it isn't fulfilled, you'll blame the politician, but that's all. They can be very difficult to monitor. It may well be that, in fact, that $5 million is part of a larger program of healthcare, and it may be that you could never monitor it. For that reason, generally speaking, you will not try to monitor political commitments, at least not formally through any formal system. You may keep a note of them, but you won't try and monitor them formally through the financial management system. Most countries, almost all countries, will monitor legal commitments. Many countries will also monitor commercial commitments through the financial management system. I don't know what the practice is in Somaliland, but you wouldn't normally monitor political commitments. And how you monitor them is something called the vote ledger. It's a method of managing commitments and expenditure against budget. The actual vote ledger isn't mentioned in the Somaliland PFM 2016, but it is required under Somaliland accounting regulations. And to fulfill the requirements of the Act, you need a vote ledger. Now I'm going to go through those transactions for the Ministry of Health and its vehicle one by one, so that we can see what happens. If we look at this example of a vote ledger and look at the column headings, first one is the description and the date, then the budget, committed, sums committed, liability, sums which become a liability, cash paid, amounts of cash paid, the warranted funds, and the budget. And on the 1st of January, at the start, at 1 minute past midnight, you have $1 million budget, you have no warrants, so you have $1 million in the budget available. Also on the 1st of January, but a little later in the day, you have the first warrant for $200,000, which means warranted funds become $200,000 and the remaining budget is therefore $800,000. On the 15th of February, you decide to order a motor vehicle. You commit $15,000. So in the commitment column, you put $15,000. Your warranted funds are now reduced by $15,000 to $185,000. Doesn't affect the remaining budget available. Okay. On the 1st of March, the motor vehicle is delivered and you receive the bill. That $15,000 now moves from the committed column to the liability column. It's no longer a commitment, it becomes an actual liability. So you must take it out of the commitment column and put it in the liability column. This does not have changed the budget, the warranted or the budget funds available. It simply moved from a commitment to a liability, but it now becomes an accounting liability. So this is the first stage in which it would be entered in your accounting system if you are using accrual accounting. And the last stage is on the 30th of March, you make the payment for the vehicle. You're a good customer and you pay at the end of the month. So it moves from the liability to a cash paid column. And if you're using cash accounting, it's only at this stage that will be recorded in your accounting records. So it's also an interesting example of the difference between accrual accounting and cash accounting, of course. And notice that at no stage do these change the warranted funds available or the remaining budget available. But what you've got is you've got a complete record all the way through of that transaction, through the various stages of the expenditure, and you know how much money you've got available to spend on other things. Obviously, the vote ledger will be much more complex because you will have multiple items to go in it. But in concept, that is what a vote ledger is and how it works. It's a very simple, very effective way of managing your budget. Now that was a single year commitment. It becomes more complex if you have multi-year commitments. For example, supposing the Ministry of Health is going to build a new hospital at a cost of $800,000 and it plans to do so over a period of 3 years. $300,000 in 2018, $400,000 in 2019, and $100,000 in 2020. Now you can set up a vote ledger which is a multi-year vote ledger. You obviously need several extra columns and it makes it more complicated. But however you do it, you do need to keep track of multi-year commitments because they reduce what we described in Workbook 1 as your fiscal space. So for example, if you've got a 2008, if you're currently in 2018, then you would record the 300,000 in your vote ledger. For 2019, you may not have a vote ledger going forwards. But what it does do is it means that in 2019, you've got $400,000 less to spend on other things. Before you can spend on another hospital or on your vaccination program, you must allow for the $400,000 that you will have to pay for that building. So multi-year commitments also need to be recorded in some format. And also under budget management, we need to talk about virements and supplementary estimates. Virements are transfers between budget heads. Now, there is no mention of virements in the PFMA 2016. They may well be allowed under your financial regulations. I haven't looked into that. They probably are. The main point is that there will be restrictions on the virements, on how much can be vired and between which heads, and you must keep a record of virements. Otherwise, you lose track of your budget. What is in the PFMA 2016 in Clause 9 is that you can have a supplementary budget. You can have an additional budget, perhaps because of a new government, a new party's voted into power, or perhaps because of some emergency that occurs. You must keep a record of both the original and the supplementary budget. Let's just look at those as an example. With a virement, let's suppose that you've got a budget for motor vehicle fuel of $30,000 and motor vehicle maintenance of $15,000. Those two total $45,000 for running motor vehicles. And you find that you've actually got too much for fuel and not enough for maintenance. So you increase your maintenance budget by $5,000 and reduce your fuel budget by $5,000. Overall, it has no impact on the total budget. It simply moves it into a different budget head. Very simply, that's what a virement is. It is important to do that, not just to, for example, charge maintenance costs to your fuel budget. You should get it right, otherwise you lose control of what's going on with your expenditure if you put it under the wrong head. So virement is an important tool. It does, of course, mean that you've got your original budget wrong, but this happens. A supplementary budget, on the other hand, well, there you decide that you just need to increase your maintenance budget by $5,000. Your fuel budget isn't too much, it's about right, but it needs to be increased. Your motor vehicle maintenance needs to be increased by $5,000. In this case, the total budget goes up from $45,000 to $50,000. So a supplementary budget will change the totals in the budget, whereas a virement simply transfers between budget heads. Expenditure control. A lot of expenditure control we won't deal with under this workbook, but I'll just go through the main objectives of expenditure control. It's to ensure that the expenditure is made for the purpose intended in accordance with the budget. That's to say, in the last one, if it's meant for maintenance of vehicles, then it must be used for maintenance of vehicles and not for buying fuel and so on. And in accordance with the laws and regulations of the country. Secondly, the expenditure control must minimize any loss through fraud, theft, or corruption. What you don't want is people buying fuel for their private car and then charging that to the government account. That would be theft. So you must have controls in place to minimize the risk of that happening. And the third requirement is to enable efficient payment. I'll talk about efficiency in a moment. So 3 objectives. Really, the first 2 of those we'll deal with in Workbook 5, so I won't say any more on those. But timely and efficient payment, the payment must be made in good time. Again, if I go to Nepal, which is a country I've worked in, they have a problem there of the monsoon and very heavy rains. And there's a problem with road building because you can only build roads in the dry season. You can't build roads in the wet season. And very often the money is not available in time for the roads to be built during the dry season. And then the people are trying to build roads in the wet season, and it really is impossible. So money must be available in good time to meet operational needs. And you don't want to spend any more than you need to on getting the money to people. There's bank charges. You want to minimize any bank charges. TSA is one way of doing that. We'll talk about in a moment. But not just bank charges, also all the indirect costs. Sometimes the bureaucratic process is so difficult and time-consuming that it actually has a substantial cost. So although you must remember the other objectives of minimizing loss through fraud, theft and corruption, at the same time you need to balance these against the costs of too much bureaucracy. And the 4th stage of our budget execution is receiving and paying money. What governments basically do is they receive money in from revenues, tax and non-tax, and from loans. And they then pay that money out in accordance with the budget, expenditure, and also repaying loans or making loans to other people. That's basically what government financial management does. Do notice in that diagram, in the circle in the middle, we have public money, cash and bank. All money received by a government entity becomes part of public money. Once that money comes into any government entity, it is public money. And it should all be recorded through the government accounting system. And that includes fees for services provided. This is often a problem and a contentious area. If, for example, hospitals charge patients fees for the services, those fees should be paid into the normal government bank accounts and become part of public money. It should not be used by the hospital without putting it through the system. Although that in fact often happens. Hospitals and schools as well will often take the fees they receive and use them directly to make the payments for salaries and other costs. But that is actually not correct. The correct way is that all the money should go into the central pool and then should be appropriated out through the budget system. And that takes us along, still really under the 4th stage of budget execution, but I'll deal with them as separate subject areas, to the concept of the Treasury single account. Now, we have mentioned this when we were talking about fund release. The traditional approach to government banking is that the Treasury will have a bank account at the central bank, and then each ministry will have its own bank account. And when you warrant funds, those funds will actually be transferred to the ministry bank account. And then the ministry will itself make payments from its own bank account. There are several disadvantages to that. First one is that you'll tend to have a lot of money lying in different bank accounts and not earning any interest. And the second one is a loss of control, because it's gone out to these different organizations and you'll rely on their accounting systems. The Treasury single account approach relies on much better modern accounting, particularly automated accounting systems such as the Somaliland financial management system that is being introduced, which enables you to get away from having separate bank accounts for each ministry and to keep a single Treasury bank account. so that when funds are warranted to the Ministry of Health, they're not paid in the Ministry of Health bank account, they stay in the Treasury single bank account, but they are there available for the Ministry of Health to spend as and when it wants to. So the Ministry of Health will pay from that central bank account rather than from its own bank account. So the concept is that Treasury uses one bank account to manage money for all ministries. In practice, you will probably have sub-accounts, and you may well have accounts at commercial banks because there may not be enough branches to the central bank. But there are ways that you can still treat those as simply being part of a Treasury single account. The major advantage is you get better control because everything is now centralized at the Treasury. You minimize the various bank balances and unused balances in those, and you have fewer transactions. They're all made through one system, so you can reduce your transaction costs. There are disadvantages. One of them is it can make bank reconciliations more difficult. Barbados, the island of Barbados, is a very small country, but has never been able to reconcile its government bank account since it's introduced a Treasury single account. The problem is that the different ministries pay money in, but they all use a few banks and a few messengers to make the payments in, and the money from the different ministries gets mixed up in different ways, and they have never been able to resolve that problem. So unless you have very good processes which are followed, it can make bank reconciliation much more difficult. It doesn't stop you having a Treasury single account, it just means that it's got to be properly managed and controlled. A Treasury single account can be centralised or distributed. Now I'm going to go on to what's a fairly technical area about the way banking works, and I don't think we need to get too much into this. Although it is in your workbook, though you do need to know about it. We talk about the Treasury single account architecture, and we have two options: a centralised Treasury single account or a distributed Treasury single account. And that's linked to the way that you process your payments. You can either have centralised payment processing or distributed payment processing. And you can get any combination of those architectures and those payment processing methods, and there are grey areas between the two extremes that we put up in this diagram. Just look at a couple of examples. I've simplified the diagrams that are in your workbooks to make this clearer, I hope. If we have a centralized Treasury single account, but a decentralized payment processing system, all the payments are made through the central bank, either its head office or any regional offices it may have. But even if the payments are made through regional offices, they all are dealt with through the single Treasury bank account in the head office of the central bank. In this example, the spending authorizations come either through the central treasury or the sub-treasuries. Payment orders go to those. Obviously, there's going to be a link from the regional treasuries to the main treasury, so you keep budgetary control. But the regional treasuries will then directly instruct the regional offices of the central bank to make the payments. So that's a decentralized payment processing system, but a centralized TSA. Contrast that with the next one, which is a distributed TSA and a decentralized payment processing system. Now, in this example, commercial banks are used. A commercial bank with a head office and regional offices. Very often you've got no choice. Very often you simply won't have central bank offices outside your capital city. And so you'll have to use commercial banks outside those. So this works in the same way, except that when the payment order is sent to the central bank, that will then send the instruction to the commercial bank or at the regional level to the local branch of the commercial bank to make the payments. But you use what's called a zero balance account for payments. Basically, the account is brought to a balance of 0 at the end of every day. So there is never actually any money in the account. And for receipts, use what are called transit accounts, which are exactly what the name says. The money is paid in and it's immediately transferred to the central bank. So although you're using commercial banks, you don't actually have any funds at those banks. The money simply passes through them. Obviously, they will require a fee for providing that service, but if there are no central bank branches in the regions, it may well be the only solution. The other problem you get, of course, with TSA is where you will make cash payments. Now, I'm sure this happens in Somaliland, that in many areas, people will want cash. They won't have banking facilities, so you'll have to have quite large payments made in cash. This simply is not part of a TSA system. You've got to get the cash out and make those payments. Obviously, you should try to minimize them, but where you do have to make them, you should treat them as petty cash. Even though the amounts are large, you should deal with it as though it was petty cash. If possible, you should use an impress system, which is described in the workbook, to maintain control over that. So practically, you will have to have cash payments, but you should try to minimize them, and where you do have them, treat them as petty cash. Bank reconciliations. A very routine area, but a very important area. Bank reconciliation is essential for effective control. Why? It's essential because it's the only external check on your amounts of cash, on your bank balances. The bank says how much you should have in there. You need to make sure that that agrees with your records, and that is a very good control. You should have a bank reconciliation completed every month, and it's not just a matter of finding the differences. You must resolve all of the differences. You must clear any outstanding items. Again, I know countries where they do a bank reconciliation and they say, we have a bank reconciliation, and they can show you what the items, the reconciling items are, but they're never cleared. That's no good. You must clear all of the reconciling items every month. And I've taken this from the workbook. This is a list of the quite likely reconciling items. I'm not going to go through this list. It's in the workbook. I think most of it's fairly clear. But it does make you realize what needs to be done. I do not think I can overemphasize the practical importance of bank reconciliations. And we'll see in cash management that you need them for a cash management program. Cash management. The objectives of cash management are fourfold. You must have cash to meet your obligations, and you must have cash available when required. We've talked about this already, part of efficiency. You should minimize the cost of holding liquid funds and making financial transactions. The TSA will help you achieve objective 3. And you should maximize any interest received. So if you've got unused funds, you don't leave it sitting in a current account. You put it where it can earn interest. And again, cash management's really just about managing this inflow and outflow, but the central box we've changed slightly now. It is to show the cash and liquid funds. And cash management is about managing the above flows and balances. That's it. The main elements of a cash management system, well, first of all, you can do it without a Treasury single account, but a Treasury single account is strongly recommended. You need up-to-date bank reconciliations because that tells you where you are. And you need forecasts of your cash receipts and payments. And there's some material in the workbook on those forecasts and how you make those forecasts. Which brings us to the last area I want to talk about, which is fiscal decentralisation. This is really a separate topic from budget execution, but I think it probably fits in best here. If you look at the way governments work, the national government is the government for the whole country, and then it's narrowed down. So the Ministry of Health is responsible for the programs of the Ministry of Health. And then under the Ministry of Health, you've got, say, hospital management is responsible for just that hospital. And there's an inverse relationship with that and the amount of budget detail. So the national government requires a high-level overview. It requires to know about everything that's going on, but only in very high-level terms. It doesn't need detail. The Ministry of Health needs information on individual entities, each health centre, each hospital, each doctor within their system. And then if you get down to an individual unit like the hospital, well, they require detailed information on their operations. They require to know information so they can get the cost per night the patient stays in hospital, the cost of providing outpatient services, detailed cost information. Now that links to the way you manage your system. A decentralized system gives managerial autonomy. It basically means that New Zealand is the country which has gone furthest in this respect, incidentally, if you're looking at examples. In New Zealand, the budget only gives very high-level allocations to ministries. It does not try to specify in any great detail how that money will be spent by a particular ministry. The great advantage of that is it says, well, the Ministry of Health knows about health. Treasury doesn't. So lets the Treasury say how much money they can have, then the Ministry of Health will make the decisions based on their detailed knowledge of the health sector. Contrast that with a centralised control system where the budget goes right down to the lowest level of detail, units and the types of expenditure. Now that obviously maximises central fiscal control and means you can centrally set policy. And obviously those are two extremes. In between you've got various options between managerial autonomy and centralised control. Another way, consider it as a balance. You've got a balance where on the one hand you've got decentralised management control, and on the other hand you've got centralised fiscal control. And the challenge is to decentralise managerial control but retain central fiscal control. And it's something which you will find you are constantly being challenged on. Right, that brings me to the end of Workbook.